person and virtually as well, just to echo her sentiment, right? We're excited you're all here. Jones & Roth, again, right, is a title sponsor. We have been for years, as she mentioned. In case you don't know much about Jones & Roth, right, we're one of the largest CPA firms headquartered here in Oregon. We have offices over in Eugene, Hillsborough, as well as Bend. We have a variety of clients in different industries, so we're certain we're going to help you when the time comes. So my discussion today, we'll talk about some considerations for startup businesses. We'll start with discussions on formation, what type of entities to select. We'll talk about accounting methods and what's available to you there. And then we'll talk about costs of starting a business and how those are treated for tax purposes. We'll wrap up with a brief discussion on intellectual property and how those are handled. And then we'll allow you to hammer me with some Q&A questions. So let's get going. We've got a brief disclaimer to claim here, and I apologize, just got to verify one more slide. Is it clicking or not? Is it go? Good? Okay. All right, so before we get started, the disclaimer here, this is not an official position, right? Any legal advice should be tailored to your situation. As you may have heard, there's a famous joke, right? How many accountants does it take to plug into a light bulb? The answer is it depends, right? It depends largely on your situation. So ask questions, no doubt. All right, so on to choosing an entity type. We're going to talk about 5 main entity structures, those being sole proprietorships, general partners. We'll talk about C-Corps, S-corporations, as well as LLCs. Sole proprietorships are the most straightforward. There's no legal formation required, and by law there's a requirement of only one owner. It also has the simplest tax reporting involved in that it's reported directly on the individual's tax return. There's no tax paid, or excuse me, there's no inherent liability with the sole proprietor. So the owner's personal assets are subject to claims from creditors and the like, so keep that in mind. Since the owner is not deemed to be an employee, they don't pay themselves wages. Rather, all net profit from the activity is taxed at income and self-employment tax rates. So keep that in mind. General partners, this is also non-required legal formation in this situation, though it's strongly recommended that there's a partnership agreement in place. There must be more than one owner by definition, and this is one of those famous pass-through entities. This means there's no income tax at the entity level. Rather, it passes through to owners at the K1 level, so keep that in mind. This also, like a sole proprietor, there's no limited liability implied with the general partnership, so the risk is still there in that situation. All owners pay their share of income tax based on their ratable share in the partnership, and it's subject to Social Security or self-employment tax as well. And this is whether or not you take draws on that income. You're taxed on that whether you take it or not, so good to know. So C corporations, this is probably our most popular entity type for these type of events. It's effectively any corporation not making an S election. In this situation, right, the net profit is reported on a Form 1120C, which is the C-Corp tax return, and the entity pays tax at the entity level. There's famous double taxation with the C-Corp, that being that dividends paid to owners are also taxed on those dividends. So you have the entity tax on the income, the dividend tax on the dividends received to the owners, and the dividends are non-deductible by the business, right? So kind of a caveat there. There varies by state in terms of state taxation on C-Corps. Here in Oregon, it's based on gross receipts, so keep in mind in terms of the states you operate in. So if an owner performs services in a C-Corp, they should take a reasonable but not an excessive salary. Liability is limited to the corporation in these instances. That is, as long as corporate formalities are observed. This would be having like a board of directors, keeping meeting minutes, things of that nature. There's usually not the most tax efficient decision for an entity that's closely held or a family business. This is generally the preferred vehicle for startups because there's flexibility in terms of share classes and exit considerations, so it's much more attractive to venture or angel investment. S corporations are the next type here, and that's simply a corporation that makes a subchapter S election under the Internal Revenue Code. You do that with a Form 2553. The caveat with an S corporation is they're restricted to 100 owners of shares. And then there's further restrictions in terms of who can hold shares, mainly that non-foreign individuals are allowed, companies are not, so important to note there. Likewise, an S corporation is also a pass-through entity, same as a partnership, right? So no entity level income tax, rather it flows through to the shareholders to pay at their level on the ratable income they are attributed. Likewise to a C corporation, S corporations also have liability limited within the corporation, assuming they meet those corporate formalities. Similar to a C Corp, S corporations, owners who do work for the company are required to take a reasonable salary. This isn't a hard fixed rule. There's not a formula in the tax law in terms of what that is. Typically speaking, it's what you would reasonably pay someone for the services you're currently providing yourself. Profit above the salary taken is not subject to self-employment tax, so there's an advantage there. And there's a lot of planning available to S corporations for that reason in terms of how much salary to take, how much to recognize as income to avoid as much SE tax as possible. It's typically a best scenario, an S election for a closely held, profitable business. That's where the planning becomes most attractive. However, S corps are not likely to receive outside investments, and we'll talk a little bit more about why that is here shortly. So LLCs is an entity formed under state statute, and for reasons that should be pretty clear, if you operate in multi-state environment, you should consult with legal counsel. And you could form an LLC in one of two ways. Either you can be, you'd have one or more members. If you're one member, you'd be considered a disregarded entity, and that means you file the same as a sole proprietor. That is, you file on your individual tax return as Schedule C. Or you could be a multi-member LLC and you'd follow the filing structure as is outlined for like a general partnership, and that you'd use a Form 1065. You'd be subject to SE tax on the profit that you recognize. Some CPAs advocate for making the S election for an LLC, but for reasons beyond the scope of this presentation, we generally don't recommend it. Owners of an LLC are considered members and there are no restrictions on the type or number of members that they can have, right? S Corp is limited to 100, they're not limited here. LLCs can have multiple classes of membership units and provide flexibility within those classes in terms of who gets paid out first and any preferential treatment as far as that goes. So we talked a little bit about tax considerations in these entity types, and I'm going to highlight a couple more things for you here so we make sure that's clear, namely that companies expecting marginal profitability or initial losses, an LLC generally is most flexible, and they permit deducting losses, and they have the least administrative hassle. When a company's profitable above the reasonable salary, as I mentioned, S corporations are typically most desirable in that scenario. If a future change to our dividend taxation is enacted, then C Corps might not be as attractive to closely held businesses, but we don't foresee that happening anytime soon. And then from a legal standpoint, right, you heard me a couple times mention limited liability. If unlimited personal liability doesn't scare you, then sole proprietorship or general partnership's generally an okay way to go. Again, least hassle, least legal costs, that is until you're sued. And then S Corps, C Corps, and LLCs, again, right, provide limited liability within the entity as long as you meet those formalities, legal formalities. There's always option later on to create additional subsidiaries, and this does not necessarily increase your tax reporting burden, rather, right, they're consolidated for purposes of tax reporting, so a lot of people do that when protecting various assets. From the standpoint of venture or angel consideration and angel investor considerations, outside passive investment, again, right, will almost never accept an S corporation. It's because it's restricted to the one type of stock. An LLC, so let me just highlight on the one type of stock, what that means is if a 50% owner takes $100,000 in distributions, the next 50% owner also has to take 100,000 distributions. So there's no flexibility into who takes what when. So a very important distinction. So an LLC does not provide, does provide some benefit in the period when they're generating losses. However, those losses you generate can only offset other passive sources of income. An example of this would be rental income. That's probably the most common scenario. An LLC is generally not preferred just for the reason that all owners have to wait to receive their K-1 before they file their tax return. So it becomes a little bit of a burden in terms of waiting on the business return to be finalized. And then likewise, you're required to file in all states that the LLC filed in or did business in. So it complicates your picture just a little bit. Beneficially for C-Corps, they provide legal oversight in the form of board of directors, which is not the case with an LLC. Additionally, C-Corps have flexibility, and you have the potential for a tax-free transfer upon exit, as well as liquidation preferences within share classes. And some funds are not permitted to invest in LLCs, mainly tax-exempt entities. They'll often have that restriction. There are options to change your entity type after formation, and it's easy to operate as an LLC and then quickly incorporate via a tax-free transfer. A C-Corp can elect to convert to an S-Corporation. However, there's a period of 5 years where you're under what's called the built-in gains period. If you sell assets during that period, you would essentially have to pay C-Corp tax rates while you're an S-Corp. So something to keep in mind if you're shifting around. So a popular topic, right, is exiting from ownership, and what does that look like? In a common scenario, say a startup sells assets and then distributes cash to their shareholders. Well, you've just triggered double taxation, right? The entity level income as well as the income paid out to investors as dividends. A common way around this is they structure their entity sale as a sale of stock, thus subjecting investors to one simple tax, right? It's a sale on the gain of stock. So important designation there. And then one thing to consider if you're acquiring a company that has a consistent level of large carry forward losses, it's potential that you acquire them and those losses are never offset, so you get no benefit for the losses that have been generated. And then I have a slide here on section 1202, which is small business stock. I'm not sure, let me just double check here. All right, so we'll skip 1202. The main reason being this is in the chopping block for the Biden tax law. It was an advantageous treatment for small business, people who own small business stock that appreciated great in value, but it's on the chopping block, so it's no longer much of an option for anybody, so keep that in mind. So we'll talk now about accounting methods, excuse me. There are two main methods we'll talk about, cash and accrual. We're not going to go into depth on hybrid accounting. That's beyond the scope here and much more involved. So the most straightforward generally is cash basis accounting, right? That's as the income comes in, that's when you recognize it as revenue. And when you purchase things, at the time you purchase them, that's when it's treated as an expense. Generally speaking, you have to elect the cash basis method on the first tax return filed. And it's not actually available to companies that have substantial inventory or those that are C corporations with over $5 million in sales. It is very useful for businesses with high receivables, but in the case of having high vendor payables and cash collections, it would actually have the opposite effect. So accrual basis of accounting recognizes revenue as you earn it and expenses as incurred. So if you signed a 24-month contract, each month you would recognize 1/24 of the income as you performed. Likewise, if you had a payable, if you prepaid insurance for 12 months, each month you'd recognize 1/12 of that insurance expense. It does eliminate common year-end strategies, the accrual method. It has a smoothing effect overall, so there's a lot less year-end strategy as far as that goes. It is available to any business, and it's required for those, again, that have significant inventory or that's inventory is important for the business. A business can convert from cash to accrual method, though oftentimes you do that Form 3115, and when you do so, there's a negative effect, an income recognition treatment that happens. You're able to spread that over 4 years, though, with the 481A adjustment, so some comfort there. So the IRS actually encourages accrual method, and they'll allow conversion at any time. Conversely, you actually have to receive a private letter ruling if you're going to switch from accrual to cash, and it's not a common thing, but you'd have to get a private letter ruling on that behalf. Because cash basis is beneficial, it's important to really consider the basis you select when you file that first tax return. All right, so we'll talk a little bit about costs of starting a business. For purposes of the IRS, there's 3 main categories they consider, that being organizational, startup, and operating expenses. Organizational costs are paid to create or organize an entity. So would be common expenses would be legal services, accounting services, expenses for temporary directors, things of that nature. It does not include costs of issuing corporate stock, as those are never deductible. Startup expenses are those paid to investigate, create, or operating expenses before business begins. This is a fact pattern decision in terms of when the business begins, and most commonly advertising, personnel, and travel would count in this category. Research and experimental expenses and development costs are excluded and always deductible. So organizational and startup expenses have the same tax treatment. That is, the first $5,000 of each category is deducted in the current year. Any amounts above that is amortized over 15 years. When you have expenses, organizational or startup expenses that exceed $50,000, you start phasing out of the deduction in the current year, so it reduces over time. Business expenses paid personally by the owner-founder or common situations before the business begins. We generally recommend that these are treated as a capital contribution on the books, or you book a loan to the shareholder to record these expenses. All right, so again, intellectual property has some unique treatment as well. Research costs of developing a patent, as well as purchasing a patent, are all treated slightly differently. Research costs are generally all reasonable costs to develop or improve a product. A product could be a pilot, a model, a process, or a formula, for instance. These costs are deductible when paid or incurred, regardless of whether business operation has begun. And there's actually a tax court case that clarifies that the deduction is not limited to projects that are successful or have some success that's probable. Self-created patents include costs obtaining a patent, which would be legal or administrative costs, and added to these costs are any costs incurred to defend the patent. Those costs are amortized over the useful life or the legal life, whichever is whichever is shorter. Costs to stop patent infringement are deducted in the current year. And acquired patents do not have as favorable treatment, namely that they have to be amortized over 15 years, regardless of what the legal life of that patent is. And then the unamortized portion is only written off if the underlying business it was acquired from is also written off as worthless. So quick note on intellectual property. It's pretty common for a founder to personally develop intellectual property and then start a company to make use of it, but without outside investment considerations, that's a sensible arrangement, no problem there. However, it's pretty unlikely for an investor to touch a company, right, that doesn't have their IP owned within the company. And they'll also be curious in terms of how you protect the IP claims. So keep that in mind. And there's an often misunderstood credit, the research credit. Previously to the PATH Act of 2016, you could only use it to offset income tax. When it was modified in 2016, they now permitted it to be used to offset payroll taxes. So for startups with employees and losses, this is a boon of a credit to deduct. So quite beneficial, but there's nuances in terms of the qualifying costs. So make sure you talk to your CPA about that. So let's go ahead and open the floor to questions. Shannon, you coming up?
Oi. Thanks, Jordan. That's awesome. So, questions from the audience, virtual and in person. These are going to show up on the screen. The code is 80855471, and that's through menti.com, menti.com. And I think we'll probably keep this screen up here until the first question rolls in. Jordan, I really appreciate that you were able to give us a lot of information, but in a way that was digestible. And I feel like this is something that should be required for anyone even considering a business. What is your, if you had just one simple thing you were going to tell a startup, what would you say?
Thank you, that was very polite. Probably LLC, consider converting later. Does depend on your situation, but like I mentioned, right, it's easy to convert later on. Some people get bogged down in making an overly complex entity structure, and then something doesn't bear fruit, and then they're stuck with a more complex tax reporting environment.
That's great. Okay, so do I have any live questions? Yes. So for IP, what are some of the common mistakes you see in startups? That's a great question.
Good question. I think, like I alluded to commonly, right, the founder will found the IP, they'll start a company, and they won't put it in, right? So it's hard for them to get initial consideration that way. And then I guess it would just be the protection of the IP against claims or copyright infringement or whatever. Those are probably the most common scenarios that come up, yeah.
That's great. Thank you. Did that answer your question well? Anybody else have a question for Jordan today? Yes.
Jordan, why do investors often want to see a C-Corp rather than an investor LLC?
Please elaborate on why investors would want to see a C-Corp rather than an LLC.
So the main reason would be that there's, you can have different levels of stock. You can have common stock, you could have preferred stock, of which within those classes you could have different treatment, different priority in terms who receive dividends first. And likewise, you could have different liquidation considerations in those different classes. So it allows you to have a priority in terms of who can get out first or who has priority upon selling those stocks. So that's the main reason for that.
Okay, and we have a virtual question. So can PATH be rolled over between tax years if the whole credit is not used? This is an awesome question. Thank you.
Yeah, I don't recall the rollover period right off the top of my head, but yeah, typically if there's an unused credit, it will be rolled forward to the next year. I can't recall if it's 5 years or 10 years that you can carry it, but you can at least roll it forward to the next immediate year. Yeah.
Okay, any other questions? Oh, yes.
So talk a little bit about S-Corp. So if I started to see Mountains and the 2553, what is that single class stock? What are the restrictions of it and why is it not attractive?
Restrictions on single class stock for an S-Corp and why is it not attractive?
Yeah, the main reason being right opposite of the C corporation, they're all the stocks treated the same, right? So if one shareholder wants to receive distributions or dividends, all of them have to receive ratable amounts based on their ownership. That's the main reason that's not attractive. Likewise, it's not common for someone who's not actively involved in the business to buy into an S corporation. That's because of that requirement to take a salary. Whereas in a C corporation, they could be a silent partner or an investor, right, and not have a requirement to take a wage on that involvement in that entity.
All right, thanks so much, Jordan. This was great. Oh, we have one more.
Can you just talk a little bit about converting from an LLC to a C-Corp and basic considerations when we'll need to make to have maximum flexibility in the C-Corp environment if you're not exactly sure what the exit strategy?
And that was going from LLC to C-Corp, is that right, Taylor? Yeah, LLC to C-Corp, some of the considerations to make it as smooth as possible.
Yeah, so you potentially have a 5-year period when you convert. You potentially have assets that have appreciated in value. That's the main concern. And then I suppose if you don't know what the exit considerations are, the risk of a C Corp is you're potentially paying double taxation, right? All dividends paid out are taxed at the individual level, and then all profit for the business, right, is taxed at that level. Conversely, if you're generating losses in the C Corp, there's potential that you're never going to get the benefit of those losses, right? If you're not making profit, those losses carry. So that's the balance there to consider. Yeah.
Ran a chill up my spine when you said double taxation. No, that's not cool, man. I'm gonna be up all night. All right, my friends, if you want more, Jordan, thank you so much. Jordan will be available for your burning questions and your specific problems during office hours. So BVC's running office hours this year. And you can book that by going to the tinyurl.com/2021BVC to make your one-on-one appointment with the pros while they last, but they are booking up, so get on it. Jordan, thanks so much for being here. It's great to have you.